Hello, 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 hello. Once again, my name is James Davis, and I would like to welcome everyone to today's webinar. Our webinar today is going to be very fruitful for you. We have some basic information, we have some charting information, and we want to do some live trading today. So, because we have so much information to go over today, we want to get right into it, okay? All right, what we want to do first is start with the presentation, and let's get to rolling. I have a nice presentation. I kind of like these numbers and everything. You see our beautiful numbers in the background. BlackRock binary trading for you. Now, we have a beautiful program for you today. Let's go ahead and get into the meat of it. I don't want to waste any time because we have a lot of information to cover. So we want to dive right into it. Okay? Now, we're dealing today with the long call strategy. We're going to go step by step. All right? This strategy is very, very simple, but you are going to have to know some basic steps before you can execute it and become very, very, very good with it. Okay? The definition of a long call strategy: buy the call option out of the money, at the money, or in the money. Don't worry, we're going to go over that. Expiration month determines when option will expire. The percentage expected, 50 to 100% profit based upon how much your money that you invest in purchasing the stocks, options. The desired trend for this particular strategy is bullish. Maintenance required. Maintenance means the maximum risk is how much money you invest in actually picking up the stock option. Okay. Now, next bit of information I have for you is the psychology. Oh yes, it's a very important terminology. The psychology in dealing with this particular strategy goes as such. Make money off the movement of the stock without buying the stock. Make greater returns in a shorter period of time. You must sell option as far away from the expiration as possible. And you remember we said all American stock options expire on every third Friday of every month. Okay? Small movement in the price of the stock is a magnified movement in the price of the option. This is to say, if your stock position goes up 50 cents, 75 cents, even $1, you could profit $3, $4, $5 off the option due to what's called the delta of the option, and we'll get to that later on. You want to buy your option contract slightly out of the money, because the purchase price is better when it's slightly out of the money, not too far, because if you get too far out of the money, it's going to take a pretty good move before it gets in the money and make you some real significant profit, and sell slightly in the money. Buy option on more volatile stock position. Volatile stock positions are stocks that we predict to move much faster than the more stable stocks. Okay. Now the characteristic, you're risky, very risky, if you don't do your research. But the 50 to 100% profit is very, very enticing. Expiry every third Friday of the month. We said that the value erodes as it moves closer toward expiration. The closer it gets toward the expiration, that third Friday, then the value is going to go. Now, you don't have any stocks to purchase in doing this particular strategy. Okay. Now your research. Your research is key. We mentioned in earlier webinars just how powerful, valuable, and important the research is. Your research is your bedrock, the foundation to your being able to actually make money in this industry. Timing the market. And timing the market is the key to let you know when to get in the trade and when to get out. In other words, when the position is at a good buying price, which The rules: buy low, sell high, buy on the dip, sell on the tip, buy the weakness, sell the strength, buy the support. You understand? And buy cheap, sell high. Those are 5 basic rules. Now, you want to do a chart test, and you can go to your trading platform or another platform, Big Chart, which is good for you. Okay? And you have four tests to qualify. The optional test, and you go to the trading platform. Now, this has been done for you because on the binary option, every single stock, every single option, you don't have to do this test. So they cover that for you. Your earnings test. Now, we are coming out of the earnings season, and we mentioned prior that earnings have a real powerful effect on the markets based upon what the companies are getting ready to say. They had expected figures to earn during the 3 months of operation, and at earnings season, they tell you whether or not they made that expectation, they overshot the expectation, or they came in below the expectation. Now, the option test, we're using 2 platforms, G option, and this is the web address, or binary option 360.com trading. That's the web address for that. Now you have a formula. Now this is the research that is very, very important for you. And these steps are key. Not one of these steps can you omit. Not one of these steps can you omit in the process of determining which stock would be good for you to trade. Okay, now your formula goes as such. Your original stock price, your call option strike price, the call option premium, the number of contracts you want to buy, how much money you have to trade with, your calculations, your break-even point, your net debit, maximum profit, which is unlimited because the position could continue to go up and up and up. Your max risk equals the call option premium. The maximum amount of money you stand to lose is your max risk. In other words, if you spend $500 purchasing your contract, and if everything goes against you, the maximum amount of money that you can lose in this particular strategy is $500. Now, I just want to make a note that because we're saying maximum risk is the call option premium, where you have other strategies that if you are not real sure of what it is you're doing, you could hemorrhage money as the position continue to go against you. It costs you more and more and more. Okay? Now, the percentage of return equals your maximum profit minus your maximum risk. Okay? The maximum risk is how much you invested in purchasing the option, and your profit is whatever you close the position on. You got $2,000 that you gross, and then certainly you subtract the 5, so your profit is $1,500, $1,500. Now the annual percentage of return is simply your percentage of return times 12, and that'll give you your annual percentage. Now your original position value equals option price times the number of shares that you bought, plus the commission. The commission, the COM, is short for your commission that the brokerage is going to get for doing the trade for you. Everybody has to get paid. Current liquidation value equals the current option price, whatever it may be, $1.50, $2, whatever you decide, times the number of shares you're going to buy, minus the commission. Now that's your current liquidation value when you want to get rid of the position, okay, when you want to sell it off. Your current liquidation profit divided by the loss equal the current position value, whatever you calculate that to be, minus the original liquidation value. And this tell you what is your liquidation profit, meaning when you sell it off, what kind of money you're going to have left. The expiration, stock in the money, the option will sell at the current option price, and proceeds will hit the account the following Monday. Now your stocks out of the money will lose all principal, meaning everything that you invested, that $500 that you put into this. Okay? Now we're going to give you a quick example, real basic example of a long call, because we want to make absolutely certain that everyone understand what we're doing and what you're doing and what you need to be doing. Okay? We don't want to leave anyone out. All right, now, here's a great example for you. And these are basic examples that I was given when I first got into it to help me to understand. Okay? Now, your example of a long call, you have a local newspaper advertise a sale on a VCR for only $129.95. The next day, Jane goes down to the electronics store intending to purchase a VCR at the advertised price. Unfortunately, by the time she arrives, the VCR is already out of stock. The manager apologized and gave her a rain check entitling Jane to buy the same VCR for the advertised price of $129.95 anytime within the next 2 months. Okay? Jane has just received a long call option which gives her the right but not the obligation to purchase the VCR at the guaranteed strike price of $129 until the expiration date 2 months away. Scenario 1. A few weeks later, Jane returns to the store to exercise a rain check. Means she's going to sell it. And the rain check is the option. The same VCR is now in stock, but the price has risen to $179.95, a $50 increase. But Jane approaching the store manager who agrees to honor the rain check and sell her a VCR for the advertised price of $129.95. Jane has just saved $50. Her long call option was it in the money. And that's beautiful. She bought the option when the price of the VCR was $129. She held the option. She went back to get it, and it had risen to $179. But she still get to purchase it at $129. That's a very good example of a call option. Now, call option review. Your call option gives traders the right to buy the underlying stock at the strike price until the market closes on the third Friday of the expiration month. So that's to say, if you buy a call option, the stock price is $50. It goes up to $60. You still have an option that you can purchase that stock for $50, which means that you have a valuable asset that has increased in value. Why? Because if you want to get a hold of those stocks, you will have to pay $60. But you're sitting here with an option contract that allows you to buy them at $50. So the value of that contract has gone up because that's a call option. And so on the other side, if you're sitting there with a put option and you buy the put option when the stock is $50, right? Now the stock goes up to $100. And so you're sitting there with a put option that you bought when the price of the stock was $50, it's gone up to $100. Guess what? You can sell your option that's more valuable now because why? It allows the person, if they want to buy that contract, to buy that stock that's now selling at $100 for $50. You understand? So this price is beautiful. Now, a call option is in the money, ITM, if its strike price is below the current price of the underlying stock. So if the stock is $50, but your call option contract strike price is $40. So it's in the money, meaning it's in a profit. A call option is out of the money, OTM, if the strike price is above the current price of the underlying stock. You see, you have to understand the relationship between what is the current price of the stock as opposed to the strike price of the option that you're holding. You have a right to sell the option when the price of the stock goes up. Your right has become more valuable now. So you can sell it at this price. Okay? The stock price is $60. You got an option that the strike price is $40. So instead of you paying the $60, you can save $20 and buy the stock at $40. Now, on the other end, the put means that your put contract increases in value when the price of the stock drops. Why? You bought the put when the stock was $50. So the strike price on the contract is $50. But the stock has fallen to $30. But you still can sell the option because you can sell the stock for the $50 price, even though it's selling for $30. And that's what makes your put option more valuable. Okay? So a call option is at the money if its strike price is the same or real close to the current price of the underlying stock. That's easy. So now this concludes the long call option from BlackRock Binary Option Trader. And what we want to do at this point, we want to go into the membership at BlackRock. We want to show you what the memberships are just for those that may not know. Okay? We don't want to leave any stone unturned. And so here we have the basic 1 day of signals. Okay? 1 day of signal will cost you $49.99. And those of you that's already pretty good, decent traders, and you know how to pop right into the platform and do some trade, then you could look at that. But now, for those that want to get a little bit more in detail by coming to the webinars and get a better foundation, better understanding, you can get 2 webinars. Visit the, you can your website, viewing access, and you get 3 days of signal each week, $500 a month. Okay, that's your basic membership. Now, for your standard membership, you get 4 days of signal each week. These are the individuals that they are a bit more aggressive and they feel it a lot better. They have a better understanding of what they're doing and they want to make more money. And so the $750, you get your website viewing access, which that'll be there. You get 3 webinars plus 1 trading session, as we're going to do today. So this is your standard membership at $750 a month. Now, for those trusted members that want to be a little bit more invested into it, you get 5 days of signal each week. Okay, and of course your website viewing access and your 4 webinars plus your 2 trading sessions. So you're going to be able to get more and more information and more training, which in turn is what increases your bottom line, and that is a beautiful price of just $1,000 per month. Now, if you have a 1-week subscription and you want to just dive into it real hard for 1 week, we have something for you also. We have a website viewing access that's normal. We have trading, question and answer with the pros, myself, and this is only $199 a week. So that's the BlackRock Binary Option Trading platform. Okay. Now, what we want to do is to go a step further, because we mentioned to you that we're going to do some real time. We're going to do some chart reading today. So we're in investing.com. Okay. And we want to take a moment and look at some stock. What we're doing today, we're looking at Apple Computer. Okay, we already have it set up, because what I did, I came in here and I set it up real time. So the market is open. Okay, and so with the market is open, we're able to look at the movement of the stock live as it takes place. All right, now in New York, it's 11:47. The market's been open a couple of hours, and you'll see right here these positioning, the value changing. Now we have Apple Computer. When you're looking at this, you want to make sure that you have the particular stock pulled up that you're looking for, because sometimes people make mistakes and they don't realize that they're looking at the chart for a different stock. So don't make that mistake. Make sure that you have the stock pulled up, the chart pulled up for the particular stock that you wanted to investigate and do your analysis. Okay. Now here we have different type stocks. Different type charts. We have the high open, low close. We have the candlesticks chart. We have the time, 1, 5, 15 minutes, 60 minutes, 5 hours a day. a week, a month, and then we can increase it. And these are your different, tools that you can use to do a real in-depth analysis of your position. Okay, so let's get into the meat of this, because these analyses are very, very important for your success in the field, in the industry. Okay. All right. Now, across the bottom is always time. 1826, 1830, 630, what have you, like that. Okay. And across the side, always dollar amounts. And that's never going to change. Okay. And so you have these lines across here determine exactly what value the position are at different times of the day. We have this set up by the day, 1829, 831, 833, 835. So we have it set up actually by the 1 minute chart. So every minute this is changing. This value is changing, okay? Now, what we did here across the bottom, what's very important is initially going to the chart, you want to step back and look and see what's taking place over a broader period of time. You could say a day. All right. And so when we look across the bottom and we'll see first month, 6th day, second month, 6th day. And today is what? February 6th, January 6th, December. And so we actually look at how many months is this? 1, 2, 3, 4, 5, 6, 7 month time period. So to give you a broad picture of what has been taking place with this particular stock position, right? Now we can shorten that by expanding our time out here. We actually can increase it, excuse me. And from the 13th, December 13th, all the way to December 14th, February, we see a whole year of activity on Apple stock. Now we want to shorten it by making this a little smaller, a lot smaller. And now we get 12, 14, 12, 30. December 30th, 2014. We get January 6th, 2015. And then we get January 23rd, 15, all the way to February 6th. And we can make it an even narrower. There we go. And so what are we looking at now? January 23rd, 28th, February 2nd, and February 6th. Okay, so we're getting closer and closer to where we at. Now we want to change to the 1 minute. You change it to 1 day, right? And the 1 day, the time is minutes, 17:03, 17:12, 17:21. You see this about a minute. Now, we see what's taking place here. And when you look at this just by 1 day in the same, by the minute in the same day, you can see that its trend is going bullish. Okay, here it was trending bearish. You understand? See? And that's real simple. Here you had a real strong bullish trend. There someone made real good money because it was trending bullish. And here it trend bearish. So it's like a seesaw, up and down, up and down. And that is the basic nature of all stocks. Stocks rise and fall, rise and fall, rise and fall. So if you're a person that's holding a stock and it falls heavy, there's no need to panic because it's going to go back up. See, that's just the basic nature of stocks. And when you have those options in there and you know what you're doing, like this is what we're teaching you so you can know what you're doing, you make money because you know what you're doing. Now, we want to take an even in-depth look into this particular Apple stock. And what's vitally important, once we see the overall trend and we see it going bullish, this area of the chart is where we're going to focus our attention to make the trade, to make the decision what to do for the day. So what we actually want to do is make the chart bigger so we can see what's taking place. All right. And so we're going to slide down here and make it bigger for us. Boom. All right. Now we can see even better what's taking place. All right. On this side, this is where we want to concentrate most of the time. Most of our energy, we want to look at that particular area on the right hand side, because this is the area that's we're going to determine exactly what's taking place with the stock. Okay. You see it's moving. This is real time. So they're making the changes according to the different option that's being moved. Now, let's go through this. This is the MACD. We have it already set up. MACD, movement, average, conversion, diversion. Okay. MACD is the strongest indicator, one of the strongest and the most popular. You know, we have the 12 and 26 day cycle. We have the 9-day on the red line. And so what this does, it allows us to see the activities of this stock and compare it to what has happened the past 12 days, past 6 days. And then an algorithm comes in and determine, according to the movement of the stock that's taking place, all of the different trades that's going on now, it has an effect. But this MACD, the way you use it is here at this particular point, you have actually a reversal of trend at the crossing right here. Here's another reversal. And so when you had the green line crossing the red line, it's telling us that it's about to change the direction. So what direction was it in? It was going bullish. So if it crossed here, it's telling me that it's going to go bearish. Then if it crosses again, it tells me it's going to swing bullish because it's coming from bearish to bullish. Okay. Now, something you need to be you need to understand. What does the difference in spacing mean? The difference in spacing mean that the further apart these lines are, the stronger this trend is going to take place. So if I see it separating here, I say, this is a good buy point right here. This is a good end. This is telling me this is about to go somewhere. And because we're trading short period of time, I could determine that from here to there is going to be a good time to stay in this position. And these lines continue to gap further and further apart. And then right here, boom, I see it's beginning to shift. I can make a decision to sell right here. And all this from this point to that point is profit. And depending on how long that takes, it's going to be real good profit. All right. Now, the next point about reading the chart. What are these black lines here for? Those black lines for to tell you how many buyers, how much activity of this particular stock is taking place in this period of time. From 1846 to 1852, right? That time of the day. 46, 47, 48, 49, 50, 51, 52. In 6 minutes, all of this activity took place. And because these indicators are here to there, 1847 to 51, about 6 minutes, someone made some decent money in here. But when they saw the trend begin to reverse, and now it's getting closer to the red line, it's telling me what? That the potential is strong, that the position is about to go bearish. But look, it didn't even touch the line. So that means it bounced off, it moved sideways, and began to trend upwards again. Okay? So this is how you read the charts. These longer lines mean it's more activity, which caused this to go strong in that direction. You see here, it didn't actually cross the red lines. It got close. But then when more buying came into here, when more people began to buy right here at 1857, 55, 56, 2 minutes, more books were sold, more demand, more purchases, which caused that position to go up. See now here, we got another reversal. So because it didn't come swing hard, it's beginning to go down. I will close my position and take the profit. Okay. And so that's Apple stock. And now that we know that Apple is in an upward tick, it's in an upward trend, now we can go over to the platform and we pop in Apple. We want to make sure it's in stock long term. And we got the expiry this second, right? The 5/10 for the closeout time. And that'll give us a chance to see and feel, okay, give us a chance to know whether or not it's going to go into favor in the position, the direction that we want it to. And because of our research, we feel strongly that this stock position is going to continue to go bullish. And so we come here, stock, long term, set the time, and you can change it. You know, if you want to change it, you can. All right. But we're leaving it here today, the 6th day of February. And we're going to go with that. Because we can go to the 13th of February, the 20th of February, the 27th. We can go to the 31st of March, which that'll give us all the time in the world to see this position swing, go bearish or bullish. But we're looking for it to go where? Bullish. And so we would come in here and put the amount of money that you want to spend. It could be $100, or it can be $200, or $250, whatever you like to spend. $500. Want to put $1,000 in there? You put $1,000 in there at 75% payout, you're gonna make $750 on this trade. Okay, so we'll just say $500. All right, so we say 500. We're gonna make a 300, and we put this position in to close out at 1710. Okay, so we can buy the position. Okay, we log in, we buy the position. And then you trade it, and we're good to go. All right. Let's do this right quick. Let's just pause this for a moment. So I'm going to pause that, get into the account, and place the trade so you can see it as we do it live. Okay. Binary 360, we're going to pop that open and get you going. All right, so one moment, let me get in here. Don't want anybody to see those secret codes. Yep. Okay. All right, let's put our information in there. Jane Davis. Just make sure we're right. Just give me 1 second. We're reloading it. Want to make sure that, you know, everybody's has went through this at least once. And the best way, you know, to get real good at this is to go ahead and get your practice account before you begin to spend any money in this. You know, I encourage you, don't be too impatient. Okay? Do not be impatient, because if you get impatient, you're going to lose your money. And that's just known. Any savvy traders or experienced traders know that you get in a rush, you're going to lose. And we don't want any losses, or as few as we possibly can. You know, I'm not going to, you know, sit and tell you that you're going to be, you know, always making a whole bunch of money all the time. But I just don't want you to get in here and get thinking that, this is a get rich quick program. All right, so we go into long term because we want to give ourselves time for the position to go in the direction that we anticipated to, and we're going to go to stocks. And once we click in the stocks, the stock page is going to load. We got Apple. We see the chart. We already read the chart. We're going to put us a nice $500 in there, and then with 75% payout, we're looking at $875. We're going to hit the call button, and we look at everything. Expiry time is going to be 1710. Asset is Apple. Rate 120. Investment 5 to payout, and hit click apply. Just that simple. And you prove it, and then we're in the position. Once you get in the position, you can come down at the bottom of the page, and you can see the position that you're in. The ID, 4906, asset, certainly everyone know that's Apple. The strike price, as we said, the strike price of the stock was $120.19. We were saying the initial 120.195, all right? Now, because we have a call option and the strike price of the contract was 120, what has to happen to the stock to make us some money at expiration? Expiration is at 1710. Okay? What has to happen to this stock? Excuse me, I'm sorry, the expiration at 17. Oh, yes, that's right. Expiration at 1710. We got 575 cents, $875. What has to happen for this stock to make money in 1710? Expiration time is 1704 in 6 minutes. Oh no. Ooh, see, now that's what I told you. That's exactly what I told you. Don't make that boo-boo. You see, this is good training for you. Now here, this is exactly what I'm telling you about. You see 13-2, 15, okay? What's today's date? The 6th. What day do we want to get in here? The 6th. No problem. We'll still buy a call because the position is still good. We believe in that. Okay? We can buy the call right now. Again. And it's no big deal. But it is a good training tool for you. Okay? And I'm not, I'm not going to pull your coat, try to make you feel, something all spooky, because this is real. You see how easily we did that? And that's how important it is to pay attention and make sure you're doing everything correct. Because you got 9-2 here. You have to come up and make sure that you're in the right position. Okay? You see right now it's too late. The position is in. And we got the start is the 6th of February and it ends the 13th of February. But now, as I was saying, what has to happen to this stock price in order to make money? We bought in at 120.19.5. It's 120.16. So that means what? We're out of the money now. But we got time. And so this is a good training session for you today. You see how we made that particular oversight. And that's real good because it shows you the reality of what's taking place. My name is James Davis. I had a beautiful time with you. If there's any questions or comment, you can mail them to me at jamesdavis@gmail.com. Okay? Have a good day. Bye-bye.